Okay, welcome everyone to this presentation on swing trading with order flow, or in other words, trading on a slightly longer term time frame using order flow. My name is Michael Valtos. I'm the founder and trader at Orderflows.com. First, a brief disclaimer. This presentation is for educational and informational purposes only. Should not be considered a solicitation to buy or sell futures contract or making any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Okay, so first, before I get started, just a brief overview of the software that we're using. I'm using the Orderflows Trader software. It runs on the NinjaTrader software platform. You can go to ninjatrader.com. It's free. You can download it for free and use it. The Orderflows Trader is a software I developed to help users read order flow. You can go to my website, www.orderflows.com, to learn more about it. Here's the website up here. And you might see a couple more additional indicators, price rejector and delta scalper, which are two order flow related indicators that we've developed and offer with the Orderflows Trader software package. If you get the whole package, we can include it. So what is the order flow? It's the way orders are executed in the market when trading is occurring as they flow into the market. There's debates on what's order flow. If you're trading with a dome, people will say, no, that's order flow. If you're trading with a footprint chart, they're saying that's not really order flow because you're trading, based on what's traded as opposed to the actual flow of orders as they're coming in and being, placed in the book. Well, that's semantics. People will say, well, you're trading in the past tense rather than the futures tense. But you know what? Let's say not half, I'd say a good portion, honestly, I think it's more than half of the orders going in and out of the order book are, are not spoofing. Spoofing's not legal anymore. But, it's sort of people gaming the system, trying to work it to their advantage. And, we're in this age of high frequency trading, and there's a lot of orders that are being worked against other markets at the same time. So, that contributes to, orders in the book and disappearing really quick. Somebody may be working, market A against market B and market C, and getting filled on one market, they got to cancel the other market. There's a lot of stuff going on nowadays in the market that, for people that don't really understand it, they think it's, the market is a rigged system. Generally speaking, the market is not rigged. It's pretty efficient. Politicians would like you to think that the market's rigged, but there are people that do try to rig it. But oftentimes they get blown up. Not in the literal sense, more of in the financial sense. But what we're going to talk about today is what time frame to trade. People that know me, that watch me trade, know that I tend to trade on a shorter term time frame. I use range charts. I use anywhere between, well, now I've even gone down to, in the last month or so, I've been experimenting a bit with 3 range charts. Usually I use 4 range, 5 range, 8 range, 10 range charts. Occasionally I'll use minute charts as well as Renko charts. But, the question keeps coming up, what's the best time frame to trade with order flow? Well, for order flow, you're really looking at intraday trading. You're not necessarily looking at, sort of, looking at a daily chart, Now, that said, I do also look at 15-minute charts and once in a while 30-minute charts. I don't look at hourly charts, especially, 4-hour charts. For me, the time frame is the trading day. I'm at that point in my life where, I've got other things going on. I'm not trading for a bank anymore. I'm not trading for a commodity trading house. So my time frame is different. I trade from a home office, and I've got kids. Okay, and anybody with kids knows that kids sort of dictate your schedule. especially if you're working from home. I try to set guidelines on when I'm not to be disturbed, but still, when a kid jumps off the sofa and bangs his head, you got to attend to him. So I tend to trade on a daily time frame. I'll go for periods. I say intraday time frame. I'll go for periods where I could concentrate for a minimum of 2 hours at a time. I find during a 2 hour period I can usually get anywhere between 3 to maybe 6 or 7 trades per 2 hour period. If I were to sit in front of the screen from the cash open until the cash close, I'm sure I can get a lot more. But at the same time, I don't have that time to devote as much anymore. In the future, when my kids get a little bit older, I probably will have the time. When school starts up, I will have the time. But for now, it's school holiday, and I'm sort of trying to work around their schedule and trade at the same time. So it's not as easy, as opposed to just leaving the house in the morning, going to an office, and sitting in front of a screen. When you're trading from home, you have other things to consider. But when people ask me what time frame to trade, my question back to them is, what type of trader are you? Are you short term, long term, and what's your risk tolerance? If you're very risk averse, you should probably be trading a short time frame where you can be in and out pretty quick. Or if you're willing to take risk and you're willing to sit through market movements, then yeah, but by all means you could probably trade on a longer term. It really comes down to the trader individual psychological makeup. I said sometimes you get people that they cannot take any risk. As soon as the market starts to go against them, they're second guessing everything, and they get out of the position. And then the position turns out to be a big winner if they had just stayed in, but they're not willing to take that little bit of risk. Me, I could take risk. That's not a question. The question is, I'm the type of person, I like to monitor a position once I'm in it, and I'm not going to go out and put on a trade and go out and run around, play with kids for 3 hours and not. Yeah, I have stops in, but still at the same time, to really maximize my gains, I really need to be watching the market and analyzing what's going on. I'd rather not get stopped out at my price. If I see conditions changing in the market, I'd rather just cut it at a smaller loss than let it go to my, let it stop me out. So, you have to ask yourself, are you, what's your view of the market? You got a short term, you got a long term. What's your risk tolerance? I think for most traders, most people come to the markets nowadays, they want to be short-term traders. They want to trade intraday. They're allured by the low margins. You can trade E-minis for, I think AMP's got it at $400. But generally, most places you can get it for $500. And, most people are drawn to that. They think, hey, I can start trading with, an account of a couple thousand, and you can. And generally, those people are going to, I'll say blow up, but they're going to lose a good portion of the money. Partly because they don't know how to trade. And so you really, if you're trading a longer term, then you're going to be holding positions past the close, and you're going to be subject to regular margins. So it's your day trade margin is still going to be 500. As soon as the market's closed, you better make sure you have the 3,500 in there to cover the position into the next session. So if you got the money in the account, and you're willing to take some risk, longer term trading is probably going to be better for you. But again, not everybody can take the risk. Everyone thinks they're, what's the word? They're strong, mentally. But as soon as they start taking a bit of heat on a trade, they monetize it and they're thinking, oh shit, I'm down $500. Oh no, I'm down 1,000. $1,000 I could have gone to go to Hawaii or something like that. Then they start to panic and and then things just go pear-shaped on them really quick. So it's kind of funny in the sense that you'll see these guys, these people will go to Vegas, and they'll set aside $5,000 as their fun money. If they lose it, great. They've had fun. These same guys, if they're trading the market, they take, it's $100, $200 against them, they're panicking. And I'm thinking, hey, you're willing to piss away $5,000 at the, $100 a hand at blackjack. And, you're going to have losing streaks in that, but, you trade the S&Ps, you're trading 1 or 2 lots and thing goes against you by a point or two and you're already panicking. You should reassess things. So, again, I'm an order flows trader, right? I developed the order flows software, and what I do is, I teach you to look for certain conditions in the market, and these conditions, they help to define supply and demand. Supply and demand is what causes the market to move. It doesn't move because, we crossed a moving average, or the oscillator crossed the zero line. No, it moves because people are buying and selling based on their needs and their perception of their needs in the future. That's what moves the market, supply and demand. And, what are some of these conditions? There are more, but, in general, the most common accepted ones, at least here, are stacked imbalances, ratio bounds high, ratio bounds low, single prints, divergences. These are the ones that my software really highlight to you. There's other things I don't want to get into right now, but, if you're interested, you can get the software or email me and, ask, whatever questions you want. I developed the software to help, traders see this in the order flow. A lot of order flow software comes out and they don't tell you how to read order flow. You don't know what to look for. Me, people that know me, they know my past. I worked at JP Morgan for 8 years as a vice president in futures trading. Cargill for 4 years. You don't know what Cargill is? Google it. It's probably the largest privately held company in the United States, and they're a big grain trader. That's how they got their money. I mean, if you buy cornflakes, or if you buy any sort of cooking oil, you go to McDonald's. McDonald's, they get all their cooking oil to cook French fries in from Cargill. It's a privately held company, but incredibly big and incredibly profitable. But they're grain traders. That's where they made their money. So, people that know me, know that, what experience that I'm bringing, it's not just, I'm not just sitting in the basement somewhere coming up with this stuff on the weekend. It's coming from practical experience. Now, with order flow, with any type of analysis, I think it has to be valid on different markets and on different time frames. It shouldn't be curve fit. Well, what's curve fitting? Curve fitting is you run a bunch of numbers through a computer, you find the optimal setting. Like say you run the MACD through every type of setting, every set number combination until you find the perfect one that never had any losses. That's a curve fit thing. Now, what you want is you need to have a set of guidelines that you can transfer between different markets and even between different time frames. So, it doesn't matter if you're looking at a 3-range chart or a 15-minute chart. What you're going to be looking for are the same conditions, right? You can, like I said, you could run. Nowadays computing power is so cheap. These computers, that you can get these days are incredible. And so people, will run all these tests, with all these different settings. You see it sometimes on these trading forums. Somebody, I've figured it out. They figured it out. Some guy in wherever, says, I've got the answer to trading. And you just take this moving average on this time frame, on this type of, with this period setting, and you cross it over with this other one. Markets don't move based on mathematical equations. People would like you to think that, but they don't. They move on supply and demand. And your job as a trader is to find where these levels of supply and demand are changing. If you could determine when a market is changing from a supply-driven market to a demand-driven market, that's where you're going to make money, because that's where the market's going to turn. And if you're having a shift in supply and demand like that, it's going to be big, and you can get big moves. So again, real quick, one of the things, let's talk about some of these again. Stacked imbalances, the ratios. The ratios are unique to me. I'm not saying I'm the first one that put them out there. You could say I don't want to say I invented it. I mean, I'm the first one that really promoted the use. Now I see some other software companies adding it into their software and calling it some sort of algo thing, which is just crazy nonsense. It's not. It's a ratio based on the volume. But they want to call it some algo because that's what people are interested in. They turn on the news and they say, oh, algos are distorting the market, so they throw algo behind it. Single prints, these are easy to see in the order flow. Divergences, when a market makes a new high and you have negative delta, that's I won't get into that, but again, you go to my website, you could learn more about all these things there. It's there for you to read. So again, whether you look at a 3-range chart or a 15-minute chart, you'll look for the same conditions. Okay, so here's a 3-minute S&P chart. You get your high, doesn't come off. You got a new high, doesn't come off. Got a new high, doesn't come off. Well, why does this high come off? Okay, well, you got your ratio here, this 31.65. You've got, a divergence. You got a new high with a negative delta. You got a very big imbalance in there. 3,500. This is a 3-range chart, and have a 3,500 selling imbalance right off the high. To me, is very important. You should get short off that alone. But so the same thing that you're looking here on this 3-range chart at the high. When you get up to a 15-minute chart, you're still going to look for the same things. Here you have your divergence. Here you have your ratio. I often say when you have your divergence, it may not necessarily give you the signal to sell off. That's going to sell off initially, but you can look to the next bar for some sort of confirmation, and you're getting it here with, the following with the ratio here. And still you're not convinced. Here it's giving you another big down bar. You got another ratio, but really these two bars here is telling you could be getting short somewhere in this bar, preferably around this point of control. Or this point of control, somewhere between these two would be an ideal entry, and you have plenty of time to do it. And this is, it's a 15-minute chart, and you're talking a move from 89 down to 79. It's a 10-point move, but at the same time, it's a 15-minute chart, so you're going to have a longer time frame than say on the 3-minute chart. 8:55. How long are you going to hold it for? You're trading a 3-range chart. Don't expect to hold the trade for 2 hours as the way you would a 15-minute chart, because a 15-minute chart, 4 bars is an hour. So you're going to be, I'll say by design, trading a 15-minute chart, you could technically hold it, I'll say overnight, but you can at least hold it into the next session, depending on when you get in. Here is a little early. If you're getting in at, say, 2:40 in the afternoon, most likely you'll be holding it till the end of the session and into the next session. Okay, so let's talk about imbalances here, stacked imbalances. And, you're still, looking at the same thing, right? Here you have the market going up, you get a selling, you come up to the swing high, you get a selling imbalance right here. And, you're going to look for this to be, resistance. Ideally, right, we open up down here, we trade back into it, and we get through it by 1, 2, 3, 4, 5 price levels. It's a 15-minute chart, so if you're going to retrace back, yeah, ideally you'd love it to retrace back right into the zone, but it's a move from 89 up to 95. It's a 6-point move. It's going to stop right at that level. Yes, you would love that, but it doesn't always work that way. Ideally what you want to be doing is getting short, on a pullback into here with a stop, maybe a point or so away, or 2 in this case. If it was a point, you'd be stopped out. But if I'm trading a 15-minute chart, I got to give it more than a point. Probably 2.5 points. Because why? Because my profit targets are going to be much bigger on a 15-minute chart than on a 3-minute chart. So if I'm getting short here at 95, and I got maybe a 2.5 point stop, so somewhere that'd be 97.5, that would be somewhere up in here. But I'm looking for a target, minimum down to the 90 area. So that's, and preferably, even below that, somewhere down around 88 or 87. So I'm risking 2.5, but to get a minimum of 5 out of it. And then you got another stacked imbalance here. We just sort of go sideways around it. This was the price rejector. Which I talk about a little bit on the website. The price rejector is giving you a buy here. Again, we're going up. Let's look at another chart. Again, 15 minutes. This time is the buying imbalance. Okay, and you're looking for the pullback into that zone. In this case, you'd get it here. It comes right down, inside the middle of the zone, and then you never come back to it. I mean, shit, man. Imagine if you could get in here at somewhere around 04, 4.5, 4 3/4, boom. Over the next, this is 7:15. Over the next 2 hours, you're trading 10 points higher. These are examples. Okay. Yeah, I tend to grab the nicer examples, but you can look for yourself and you can see it. So it's the same thing. Whether you're looking at it now, this is a 3-range E-mini stacked imbalance. Okay. Here you get the stacked imbalance 1, 2, 3. You get to pull back into it and you sell off. Okay. So what is this? 85.5 right here. Down to 83.5. So it's a 2-point move. It's a 3-range chart. So you're getting 4 price levels. So to get 2 points is good on a 3-range chart. On a 15-minute chart though, you're looking for higher profits. You're looking for bigger moves, and you see it here. Right? That's why you're able to get 10 points. Even in this other chart, at a minimum, you should be looking at 5 points. You could have been 80, 95. It did trade down to 85. That's a very strong move. That's 10 points. Me, I'd be happy with 5 points actually. On a 3-range chart, hey, 2 points is a gift. I know. I said, recently I just started looking into 3-range charts. Usually I stick with 5-range, but a 5-range, I was going for 2 to 3 points, and someone told me about, I should look at a 3-range chart and try and work with it, and I have been, and I'm finding, anywhere between around 2 points is a good move on a 3-range chart. On a 3-range chart, it's a very short-term chart. So I'm not looking to hold the trade very long, and I'm not looking to get 10 points out of it. It's trading on a short-term time frame. You should be looking at short-term, tighter targets. So, just to recap, with longer-term charts, there's more profit potential, but you take on more risk. Why do I say that? Because when I say take on more risk, it means, one, you're in the trade longer. So anytime you're in a trade, you're always at risk. Okay, it's not gonna, you could be in the money, but you're still in the market, so you're still exposed. And if you've been around the markets long enough, you know that the unexpected can and does happen. Now, with short-term charts, you're going to be in and out a lot more because you're going to have a shorter trade duration. With a 15-minute chart, you may get 1, 2, 3 trades a day. Some days you may get none, but you're going to be holding it for a lot longer time. With a shorter term chart, you're going to be in and out, multiple times during the day, and like I said, you're not looking to hold a trade from that you take from a 4-range chart. You're not going to hold it until the close, unless you're taking it 5 minutes before the close. It's something you're going to hold until either it hits your profit target, stops you out, or is going sideways on you, over the short term. Okay, so this just sort of leads me on to my next topic. People talk about order flow, and some people have you believe that it's the holy grail to trading. It's not. If you're looking for a holy grail, you'll really be looking for a long time. And how do I know? Why do I say that? Future trading, trading in general has attracts the brightest, sharpest minds in the world. Nowadays, in the past when you had the trading floors, the CBOT, CME, IMEX, you could literally go down there, out of high school and get a job there, and within 6 months you could know if you're going to survive in this business or not. You didn't need a college degree. I know guys that went down there after graduating high school, were supposed to go to college in the fall, and they never went to college. They just stayed on the floor. They made millions of dollars on the floor. They're not, rocket scientists. Nowadays, honestly, you kind of do need to, I say you need to be a rocket scientist, but you see a lot of jobs, that these people, they want quants. They want these, I'll say geeks, but, they want these guys that have PhDs in applied mathematics and things. I don't like the way that it's going, but, that's where the market is going. So, if you think you're going to find a holy grail, forget it. Like I said, the sharpest minds in the world have been analyzing the futures markets for many years, and they haven't found the holy grail. Now don't get me wrong. You can make very good money trading. Like I said, you don't need to be a rocket scientist. There is some science to it, but it's definitely not rocket science. People do make millions of dollars trading that aren't exactly I'll say the sharpest tool in the shed. I mean, they're not idiots and everything like that, but they know how to adapt. If I was setting up a prop trading firm, I wouldn't be looking for rocket scientists, PhDs. I'd be looking for gaming freaks, guys that are good at playing video games. That's just me. I haven't gotten to that point yet where I'm going to do an experiment like that. But if I was, that's what I'd be looking for. And order flow is a great way to trade. It's a great method to trade the market. It's a great way to look at the markets because you're seeing a lot of information people out there aren't paying attention to. But what the information that you're seeing with order flows is very pertinent information that's very telling on what they're doing in the market, what people are doing in the market. So, I provide you, like I say here, a real no fluff, simple and effective trading strategy that anybody could follow with ease. If people ask, they've got no experience in trading, should they use order flow? Yeah, of course you should. Order flow gives you an insight into the market that very few people are paying attention to. So, make no mistake, Orderflows Trader is not a method with 1,000 indicators and chart tools that hinder you rather than help you. I see some charts sometimes and I just shake my head. I really can't understand what they're looking at. And I've been in the markets for 20 years, so I know of a lot of the technical analysis that's out there, and and really it's some of it is so much analysis that goes into it. You can't get your head around it. And sometimes you can't even tell which side of the chart is up and down. So order flows, again, it's not a method with 1,000 different things you got to look at. You're not looking at every single trade that goes through. You're looking for certain things to happen in the market. And as a trader, you're going to be looking to anticipate them and then react to it. A lot of people that I've worked with, that I've taught order flows trading to, they get to a point where they tell me, now I get it. They understand. They could sit there and watch the market and see how it's developing, how things are unfolding, and then if it unfolds this way, they'll do this. If it unfolds that way, they can do that. That's where you want to get in trading. It's like driving a car, right? When you're driving a car, yeah, initially you probably read a book on driving. When you're in your driving school, it said, hey, read this manual on how to, the rules of the road type stuff. But as you're driving, you don't keep referring back to that. You've internalized it. And that's what you have to do with, with the market. That's what order flow will allow you to do. It'll allow you to internalize the market. Like I said, compared to driving, you're driving down the road, some guy cuts you off. You don't have to sit there and flip through a book to see, oh my gosh, what am I supposed to do? You know what to do. You react, right? You're still alive, right? So you obviously, you have some skill, and that skill is there in you. So you can learn trading just as you can learn to drive a car. My wife never drove a car before, but she's learned. She has to learn how to drive a car, and now she thinks she's the greatest driver in the world, even telling me how to drive. But still, when you're you can internalize what you're learning, then that's the best way to do it. And order flows, I think, gives you that opportunity to understand the market at a level that a lot of people don't understand. Again, why so many people fail at trading. Well, if you want to earn serious money in the markets, then you need to learn to read the market and understand what the market is telling you. So, if you're just trading with some, indicator saying buy here, sell there, or we've crossed this line, or we've hit this second deviation, things like that, we've crossed the zero line, or this oscillator went from, it's got a divergence on the oscillator, or it's got crossed the zero line, or the ADX has gone, minus 20. And that's not trading. You don't understand what the market is doing. You're just reacting off of some mathematically derived number rather than what the actual market is telling you to do. If the market says sell here, you should sell. You don't sell it because some indicator is flashing a red arrow here. So, that's, if you want to be a trader, you got to know how to trade. You don't, and knowing how to trade is knowing how to read the market, understanding what the market is telling you, and react off of it, basically. So, in that case, I'll end this. I'll end this today. But again, if anybody's interested in the software, you can email me, mike@orderflows.com. I got a special deal on everything right now: Orderflows Trader, Delta Scalper Price Rejector, the trading course. It's not advertised on the website, but if you're interested, it's a big discount off of what you're seeing on the website. But it's for people that really are interested in learning how to trade with order flow. I said I don't charge an arm and a leg for the software. I did do some work on it, but and I do want to get get paid a little bit for my time. But again, it's not a full-blown business in that sense, in the sense that that's my main business. I make my money from the markets, not from selling the software. So again, you can email me with any questions or queries. And I'd like to meet other traders. Sometimes that's how everybody learns. I learn. I'll say I learn, but I have my ways of thinking. But sometimes people say, hey, I've been using this software this way. And honestly, people use order flows for different purposes. I know some people use it. They're really only they have their own way of trading, and they want to know what happens in the order flow when it gets to one of their levels. That say they've been trading, they've had their levels way of calculating it for years, and they're set in that way. They'll never change. But if they can see how the order flow is trading at their levels, they can refine their entries. So you don't have to necessarily learn the way I trade, but if you were to add order flow trading into the way you're currently trading, then it can probably help you. A lot of people don't realize that. I'm not asking you, when you come to trading with order flow, to change the way you're trading. A lot of people they're adapting order flow into their style of trading, and they're very they're very pleased with the results. So thank you for watching this video, and to learn more about Orderflow's software, or anything about order flow that I have to explain, you could either subscribe to my YouTube channel. There's a ton of videos. I tend to put a video up each day, thereabouts. And also go to my website, www.orderflows.com. I have a lot of information on the website. Some people say, oh, you're giving away too much. You know what? It's not about having to charge for information. Yeah, I do. I share it. People have shared information with me, throughout my career. I've known a lot of very big traders. I've had the good fortune of being in the markets from the mid-90s up until 2013, and trading at very respected companies, and having access to traders, market wizards, a lot of these guys that have written books, I've known, I've spoken to on the phone many times in my career about about the markets. I'm not going to sit here and drop names or anything, but each market wizard's book, there's probably several traders in there that I've dealt with on a daily basis for many years, and people that other respected authors and things. I know a lot of, I've met and had interactions with a lot of very successful traders, and a lot of them you'll never even hear of, because most traders that are successful tend to fly under the radar. They don't, drive around in flashy cars and, and have fly around in helicopters. Although my our old boss at J.P. Morgan did, he was into flying with helicopters and whatnot. If you ever read that book, shit, I can't remember the guy's name, but it was funny. His name escapes me now, and what it was when when they were talking about going, I think fully electronic, either fully electronic or still on the board of trade of the CME. There was like an extraordinary member meeting or something like that where all the members had to go into this place. I think it was in Wisconsin, and discuss are they going to do it or not. And this one trader was writing about it, and he was saying, yeah, I was very impressed. You look in the parking lot and saw all these fancy sports cars, Bentleys, Ferraris. Well, Bentley's not a sports car, but it's a luxury car. Mercedes, high-end Mercedes, things like that. And then, I thought I seen it all. And then the guy from J.P. Morgan, he was a nice guy. The guy from J.P. He's a very nice guy. He was very, you think someone that high up is, unapproachable, but he was very nice. And, he showed up in a helicopter. But that was due to he's a bit of an aviation guy. So, so a lot of the people that are very successful in the markets, you don't really hear about, unless they come out and write a book or something like that. And but there's a lot of people that have made tons of money that just sort of fly under the radar. They're happy to grind it out, make a few million a year, and be happy with that. I'm not saying that you're going to make a few million a year, but if you learn how to trade and trade right, you can make a living doing it. You can make good money doing it. You can supplement your income doing it, even if you don't do it full time. So trading can turn your life around. So that's, I guess, a little pep talk there at the end. So again, anyway, visit my website, www.orderflows.com, and if you're interested in learning more about order flow and how it can help your trading. So thank you, and see you on the inside. Bye-bye.